So speaking of history, we are going to kick off FinFair with some true icons of Wall Street. These are the icons of the new issue market. These are gentlemen that have brought some of the biggest names in the world public, names that have changed our lives, the Intels of the world. And these were the people that made NASDAQ. It was nothing more than a little over-the-counter marketplace, transform into the greatest capitalism engine that the world has ever seen. And they've come here today. I think they bring tremendous amounts of wisdom and insight that I think that they'll be able to really share to some of today's rising FinTech pioneers. And they're going to bring some of that wisdom along with, I think, some of these exciting and interesting behind-the-scenes stories. So I am really excited. Please welcome Andy Blum, Richie Friedman, Humbert Powell, and Andy Mallett. Okay, you guys all set there?
I think so.
Great.
Sorry.
Well, first, it really is such a true honor for me to have the opportunity to moderate this panel. I mean, you guys are my idols in the business, and I know Richie. I love hearing a lot of your stories and from all the interesting companies that the brands that we know today. Were made possible because these guys brought the people's capital to that innovation and to those companies. So I thought maybe we'd start off with you guys first, maybe doing a little brief introduction, and then we'll jump into some fun questions.
Okay.
Okay.
You want to ask questions? Or
you want to do a little brief intro, each one?
Ahead,
talk
Richie.
a little bit about your...
We're going to go in age order, Richie. Go ahead.
that makes sense. I have, first of all, Dara, thank you. And I think this is fantastic and interesting. Over a period of years, I've done similar things, and I guess that I probably have been in the business longer than most of you have been on Earth. I started September of 1951, so that sort of covers most of you. It takes you out. And, it's been an unbelievable experience. Dara was talking about Intel. What she didn't tell you, before Intel went up 200 and some odd %, it halved itself. And that was the first thing out of the box. And the second thing was that in the negotiations which you had with the venture capital sector, in this case his name was Arthur Rock, he wanted to do the deal at 25. We didn't want to do the deal at 25, and we did it a couple points lower. It opened up at 25, and that was 1971, so I was a bit younger, and I was cornered by this famous guy telling what an unbelievable chiseler I was. He'd never met anybody in his life like me. I'd have no future. I'd never last in Wall Street because he couldn't do to people like himself what I had done to him. Well, and then I was right because they couldn't ship the damn things, and the thing, I think in nice round numbers, it halved itself.
It did.
So,
it went to actually 9.5.
Well, I got 11, but it doesn't matter.
Yeah.
That's probably where you bought it, because you bought a discount from Richie.
Which was not easy to do.
I remember. And it's been fascinating. Again, it's interesting with Richie, because Richie started something that a guy named Buzzy Goodell turned into a multi-millionaire game of the new issue market. But Richie was able to get a roadmap of where deals were and what they were going to do, et cetera, et cetera. And there were, umpteen stories. And one that I remember vividly, first of all, when I met Richie, people said, well, why are you dealing with him? He does all the stuff that goes around the corner. I said, because the guy is a fact of life. How can you not deal with a guy that's making your deals go or not go? And somewhere in the, I guess the 70s, Morgan Stanley did a deal called Hamilton Brothers Exploration, and Larry Parker was the syndicate guy there, and he called me up for a feel of the market. Well, I didn't have any feel of the market. I called Richie, but nobody knew that at the time. So there was a cocktail party, and I told him, his people said it was great. Richie said it wasn't great. There was a cocktail party that afternoon at a firm called Newhart Cook, and Larry pulled me out, and he said, can you tell me again what you told? I said, well, I said, I'll make it simple. If you meet me at 72 Wall, which is where Gregory & Sons was at that stage, I'll introduce you to a guy who'll tell you exactly. Then I thought, Jesus, I better call Richie and tell him what I've done. So we called 4830-100. I can remember that number. I can't remember my age.
He's unbelievable.
And at the following morning at 7:30 or so, Richie met Larry Parker, which was really, somebody should have had a camera and made a note of it, because it was such an unusual spin. You know, again, just the bottom line was that Richie was late. But, you know, the changes, Hanbeck and Quist and ourselves had a deal called Amdahl in registration, and the CEO was killed in an underwater diving accident or whatever, scuba diving, whatever, but it was under that. And the deal went bye-bye, and First Boston got it, and a guy named George Needham got it, who now has had the good taste to hire Mr. Malik and make him the head knocker. And so we lost it. Needham had it, and he was at First Boston at the time. And we called him up with someone who wasn't here today, Mel Lavitt, and said, you know, we can probably be helpful. This is, again, how the world has changed. We can probably be helpful because we know the buyers for, you know, slim high-tech companies. You're dealing with American Telephone, General Motors, U.S. Steel, Exxon. You don't know who the buyers are. And I must say they were very, very nice, and that was the beginning of a great relationship with George. So the deal comes effective. We got a nice chunk of stock, and I called over to our trading desk. Underberg Tobin at the time was about half the size of this room. And I said to Mike Gilfillan, trader, Mike, what's First Boston's market in Amdahl? He said, what are you talking about? They don't trade it. I said, they don't trade their IPOs? He said, no. And George Chin was then the senior, this is my last story, was the senior partner of First Boston. I called him up and I said, Mr. Chin, it wasn't George. You know, you guys aren't trading. He said, no, we're investment bankers. We don't trade stocks. I said, well, let me tell you what we do. And you can make more money, and maybe I wasn't quite as crass as that, trading these things in the aftermarket because you know where the order flow is, than you'll make on the spread. He said, that's interesting. He said, can I come over and talk to you? And I thought, holy moly, I can't have George Shin come over to little old Lunenburg Tobin. I said, Mr. Shin, I'll come over to 20 Exchange Place. And I started talking to him. He said, that's so interesting. Can I call somebody in? I said, sure. And he called in Peter Buchanan, who then was running the trading department and then became the head of First Boston ultimately. So, you know, how the world has evolved. We're investment bankers. We don't trade stocks. So I've got a million stories, but I'm gonna give up with that and let somebody else babble for a while.
Just two codicils to that. Number one, when you called First Boston's trading desk, you got an answering machine. That's a joke. That's how responsive they were in those days. And when Tom Underberg came to me and said, we're going to bring a company public called Intel, Tom Underberg, for those of you who don't know him, is somewhat of a character, and talk about iconic.
Monosyllabic.
And as he was leaving, I said, what do they make? And God forbid he should say memory or microprocessor. He said 4K RAMs. And as he's leaving, I said, is that a condom? It's a true story. And at the closing dinner, Tommy Underberg says, and Malik thinks you may. Anyway,
That's great.
just two codicils on that story.
Okay, I'll go next. Right, Humbert? Okay. Basically, Dara, thank you, number one. And we've got a great turnout here for two reasons. One being Dara's all along. Second, people that know me wanted to see if I showed up in shorts and my sneakers. Which, and that was the reason I think most of you people here, more so for Dara, of course. I don't want to take too much wind out of her sail. But anyway, I'd like to give you a couple of situations that I was involved in. There was a stock many years ago, Genetech, that was first going public. And the underwriter who was pricing the deal was Hambrecht and Quist. So I get a call from the syndicate manager, John Dakin, and he says, Richie, Bill would like to find out if we're pricing
Also Arthur Rock, by the way.
I'm sorry?
Also Arthur Rock.
Okay, we'll put him in also. Well, anyway, they were going to do 1 million shares at 25. And John Dakin, Bill's syndicate manager, said, Bill wants to know if we bumped the stock up to 30, would it hurt the deal? I said, John, why don't you go back and tell Bill to make it 35 because we're going to open at 50. He was dead silence at the other end. I said, John, are you there? He says, yeah, he says, Richie, we never doubt you. He says, I'm going back to Bill. Sure enough, they priced it at 35. The stock opened at 50, and that same day it ran to 88, wow. Which was unbelievable in those days. Today, you know, you get stocks like that, but not as crazy as that was. And that was one of the deals. And on the other side of the coin, you know, I was trying to help a guy by the name of Crazy Eddie, which I'm sure some of you
and talk.
I tell you, Crazy, I mean, every one of them be sitting in a room. You would buy the Brooklyn Bridge 100%, 100%. He'd sell 400% of the Brooklyn Bridge, and we all go out and say, oh, thanks, Eddie, that was great. But long story short, with Eddie, Oppenheimer was doing the deal, and the syndicate manager at the time was Joe Missett, who I was friendly with. And the price was $11.13, and then they dropped it down to $10.12. And then Crazy Eddie, one of his relatives, approached me. They said, can Crazy come up and meet you? I said, sure, be my guest, no problem. So he came up, and we started talking. We had a couple of meetings. I said, look, Eddie, if we price this thing 8 to 10, price it at 8, it opens up at 8 3/4, would you be upset with me? He says, Richie, I want everybody to make money in my stock. I said, okay, that's a good start. I said, you know, then I contacted a few of my friends around the street, and they said, well, we'll get an interest in it. And this deal was pretty much sold in no time flat. I went back to Oppie, and I said, Joe, let's price this thing at 8. And even if it opens at 8 3/4, supposedly Eddie's not going to be upset. Great. Priced it at 8. It did open up 8 3/4. And I guess everybody else knows the history of Crazy Eddie. But he was some piece of work. I mean, there's a lot more stories to tell, but I let my friend Humbit add a few things.
Well, yeah, you're listening to over 200 years of experience sitting up here on these chairs. Dara, thank you for inviting the four of us to speak. And, you know, the story is, you know, what went on in the 70s, 50s, 60s, and 70s. Andy used to work Saturdays because the market was open 6 days. Then there was time markets were closed on Wednesday, which gave everybody on Wall Street a day to goof off, but the orders would pile up and sink everything on Thursday. But I think what you're hearing and what we all lived in is relationship and communication times. I mean, everybody knew everybody. Everybody went to conventions. Everybody helped everybody. And that today, the big, powerful firms, and some of you are probably sitting in the room here, so I won't use the names, but a deal is a deal to them, and it's a financing fee, and they're on to the next one. I mean, there are major firms that sometimes price 5 or 6 deals in an afternoon, of which we've been co-managers on some, and they just walk in and say, here's the price, take it or leave it, because the banker cares about the management fee, and he's going to get his bonus at the end of the year. And when I used to run banking at Bear Stearns with 300 bankers, they'd come in and ask for $1 million because they were, quote, an investment banker. Whether they brought any business and it was successful or not was immaterial, because the 80s with Mike Milken and Drexel changed the whole compensation schedule that we all grew up in, where it was all relationships. We all took care of everybody. As I said to Andy and Rich the other day, if the head of Merrill Lynch, man named Dick Gillette, that ran over there died, there'd be 200 people show up at his funeral. If the guy that ran Merrill Lynch or J.P. Morgan or Morgan Stanley that died, there wouldn't be 5 people show up at his funeral, because he doesn't know anybody, nor does he want to know anybody, because it's all self-contained, it's all me, me, me. Where in the old days, every one of us took care of everybody. You know, if you had a problem, I mean, you're talking about Genentech with Hamrick and Blythe Eastman. The guy that ran Blythe Eastman and the books over there closed the books and called me up after the closing and said, I've already processed all my tickets and I'm long 1,000 shares. Can I give it to you? I was at E.F. Hutton then. He said, can I give you the 1,000 shares because I don't want to change the back office allocation? I said, "Si, stock's up 50 points. Yeah, I think I can place it." But I mean, that would never happen today. You know, we used to keep all the retentions on a yellow legal pad before the computers came in, and we were talking earlier. I mean, nobody talks to anybody today. It's all emails and IMs and so forth, and nobody really cares about anybody like they did in the 50s to the mid-80s, when everybody took care of everybody. If you had a problem, you know, your buddies on the street. I mean, you talk about conventions and everything else. The one story I can remember when Carter, Berlin, and Weil was in business, and we'd go down to Boca Raton for a conference every year. And then there was the St. Louis room where you'd have drinks after dinner. And Sandy Weil was giving me a hard time at E.F. Hutton when I ran capital markets there. And I turned to Sandy and said, Sandy, if I were you, I wouldn't give up my legal degree in case you don't make it on Wall Street and fall back in the legal profession. I mean, that's the kind of relationship we all grew up with, guys and girls. You know, and I think we, as the older generation, miss those kind of relationships. It's never going to go back to that because it's just too much money, too many deals, and forget the Alibaba has to go up, 3,000% to match Intel, which these guys did. But it's a market that we're not used to because we're the relationship guys that used to take care and work together. And Richie would help us. And today nobody wants to talk to Richie because they're not smart enough to talk to him. So I'd like to, unless somebody else has something, let you ask questions.
Well, I have something to add. I apologize. Well, what we try to do at Needham, particularly since we bank for smaller cap, generally emerging growth companies, is tangentially what these gurus have been talking about, which is called price discovery. I mean, the whole idea of doing a successful transaction is getting the most amount of shares into the realest hands, the longest term holders, the most suitable holders, if you will. And that's the whole idea of price discovery. And I think, to Humbert's point, the larger firms, which shall be nameless, tend to do smaller deals in a cookie cutter fashion and tend to market them to institutions that generally aren't suitable. Fidelity has $4 trillion under management, whatever the number is. For them to get 200,000 shares of a stock that's going to go up 50 cents is completely meaningless. In fact, and what Richie helped facilitate and the one-to-one relationships we had. And of course, we were able to do that because the deals were smaller generally, a la what's going on now, and we could put our arms around the deals. And what Richie helped to do, as I said before, was facilitate really price discovery. And he gave a couple of remarkable examples, and that's not happening today. I mean, there's certainly a conveyor belt attitude in capital markets about doing transactions. When we participate in transactions, our capital's on the line, and so we see the lead managers' pot allocations. And I would say of every single hot deal we've been on, of the top 50 names, 90% are the same names. And on a long-term basis, 6 months out and a year out, most of those holders have sold those shares. And in fact, it's more the Needham-like accounts, the smaller emerging growth fund managers that hold those shares. Why? Because that's why they have the money. Those shares and those companies are suitable for them. So I think what's happening, I apologize for this, just to come full circle, I mean, with Reg A and with whether it's technology or the infrastructure that's coming about, as seen by our sponsors among others, that whole notion, if you will, of price discovery in the small cap area is getting traction and meaning. And we have come full circle because everything Andy Blum talked about, and Humbert and Richie, was really facilitating price discovery. And what you need today for small cap, really small transactions is the ability to find the right buyers for this merchandise. And that's what's happening now.
In terms of relationships, which was so important, and people, and it wasn't, well, if I do this for Humbert, will he do that? You didn't think about it. It was a relationship, and you did it. And there's one story that couldn't happen today. I was with a firm that went bye-bye, and we were underwater. Things were done that shouldn't have been done, and we were out of compliance. And I was sent out to try to square it away. And I was able, and this was in 1969, I was able to call Gus Levy, who was the head of Goldman Sachs, Cy Lewis, who was the head of Bear Stearns, Dan Lufkin at Donaldson Lufkin, just for three, and say, we've screwed up, we need some Bordeaux, or we're going bye-bye. Not one of them said, what kind of a jerk are you? How did you do that? It was so stupid, blah, blah, blah. Everybody said, how much? I said $1. Well, we'll pick up part of it. Well, it wouldn't happen today, and that's absolutely true. I sat in the New York Stock Exchange and I dialed and cried because the response was so unbelievable from guys. I mean, Gus Levy and Cy Lewis were my best friends, but they were the major knockers, and I had an ability to dialogue with them. You couldn't do that today. If you called up today and said, I've had a problem and I need $1, they say, sorry,
Sure
Andy,
problem.
bye-bye. Sorry, Dara, go ahead.
No, I was going to say, what do you guys think now with the new regulatory environment? I mean, do you think that I mean, you've seen over the years, I mean, just so much increased regulations that have just made it really impossible to want to work with small companies or small investors. Do you feel that changes in the air, or do you think that will this really open up new doors for smaller company?
Well, I actually think it's been a double-edged sword for a firm like mine. The Jobs Act has some great aspects to it. The test of waters, the confidential filings, and so on. Of course, there was something in the papers yesterday about alerting people about that you've just filed confidentially, for sale sign, for sale sign. But that said, that's been really positive, particularly the test of waters, because in smaller, it all goes back to the suitability and finding the right buyers. In smaller offerings, you really do need to find, particularly ones that aren't hot deals, that are household names. When Uber goes public, I don't think you'll have to do any test of waters. But when smaller companies, it really is getting buyers on the shelf while you're in the quiet period. It's really a great innovation and really mitigates any price volatility when you price the transaction, because you really have a sense of who the natural buyer is going to be. Now, on the other hand, many of the aspects of Dodd-Frank and the Jobs Act and some others really make the process much more cumbersome with respect.
And expensive.
What?
And expensive.
And expensive, but much more cumbersome. The whole notion of bankers and analysts and what we can and can't do and when we can see companies and so on really does make it. And to Andy's point about expense, we have 160 people at Needham, and we have 5 compliance officers. But we have more compliance officers per capita than any firm on Wall Street.
Wow.
I thought J.P. Morgan is just hiring 16.
The largest expense at
16.
Morgan Stanley today is their compliance department.
Wow.
So just kind of from where the rubber meets the road, that's and also, since we have an asset management arm, Needham does. I mean, there's an upside to this, but I just can't see George anymore. He runs our asset management business. You can figure out what the upside is.
To the stock.
We've done, I don't know, 40 or 50 confidentially marketed public offerings. If anybody wants to know what that is, I can bore you to tears with it. But in that, of the 40 to 50 we've done, we've had a FINRA inquiry on every single one of them.
Wow.
And by the way, with no change or anything, but every single one. Think about that, the time and effort to put through to fill out the questionnaires. Every single one. BlackBerry's revenge.
It'll be interesting, because now with Title III coming live, I mean, a lot of platforms are gearing up for that, and I think that they're going to be in shock once they realize that they're under the FINRA umbrella and what it's like to have an audit.
Just on the FINRA subject, somewhere in my little career, I was chairman of the district for what was then the NASD, which is now the FINRA, and ended up on the board of the NASD. And then when Rothschild Underberg imploded, I ended up working at the NASD, which was an unbelievable education in the context that they were unbelievably well-educated lawyers, blah, blah, blah. And I got involved with the corporate finance end, because I said to, and at the time I said, there's nobody, this is to Gordon Macklin, who was the founder of NASDAQ. Mm-hmm. I said, you have nobody on these committees that has ever written a ticket. Everybody on the committees were, homegrown lawyers. Very knowledgeable, knew everything from the books, but they didn't know the give and take of writing a ticket, of doing a transaction, whether it was selling shares or putting an underwriting together. And it was extraordinary. I mean, I was aware of it, not as aware of that. And also, at the same time, some of this comes about in the form of a self-inflicted wound, because this gets out in the open and Mr. Jones gets shafted, and suddenly 50,000 Mr. Joneses or 500,000 are out there saying, you know, Wall Street is a dirty place. And it's great in Washington or Albany or wherever you want to go to say those people, I won't say guys, sorry ladies, on Wall Street are you know, a bunch of crooks who are doing everything they can to beat it out of you.
What would you guys say, one piece of advice for someone starting off in the business today?
Make friends and communicate.
That's a good one. Oh, Andy Blum told me that a long time ago when I went kind of off the firing line with speaking to institutions directly. That's my fault, I apologize. I got this thing yesterday. I have no idea how to work it. Literally yesterday.
It's like your mind duck call.
It's a call from Israel.
You can do what Brody did with it, throw it against the wall.
It's a call from Israel. But I forgot what I was talking about. Oh, the piece of advice is Andy Blum said to me, don't give up your relationships. And he's absolutely right. It really is a people business. I would say, though, just this is kind of an observation on your slide presentation, Dara. I mean, there's a tiny disconnect. When you think of Goldman and Morgan Stanley and UBS and some others, they're high net worth individuals, a little different than the ones you're addressing. Right. So they are quasi institutions and treated that way. I mean, if one really gets to the uninvested, that's probably part of the eleemosynary part of it, or the altruistic part. And I really mean it altruistically, because I mean, who of us who out there is going to get Uber shares or got Uber shares before it went to a $40 billion valuation, or Palantir at 30, whatever the numbers are, they're astonishing. So if somehow that can be facilitated, it would be great for this country.
Just another, in terms of reality checks, we were involved because of a relationship with the Rockefellers, because our former partner, Belmont Tobin, was smart enough during the war to share an office with Lawrence Rockefeller, which was very helpful as they both got out of the service. And so we had access to a little company that they were involved with called Apple. And I was digging my way out of this mess that I referred to earlier, and I went to two people at our firm who had tech background, sales background, all of the above, and said, it was Furneaux and Martin, Andy.
Yeah.
And I said, you know, what should I do? I have an opportunity to be a buyer on this first generation of Apple. And they looked at it, and the bottom line was, they said, you know, because of your finances, which were zero, and I was going to make a huge $10,000 investment, you shouldn't do it, because we don't think that this laptop computer game is anything but a snare and delusion, and it won't last. So again, you know, going to two guys who are highly knowledgeable and so on, you know.
Slotnick still owns his.
Yeah, well, I know. Yeah. But you know, how you can misread and get information, which, you know, was you know, well thought out. That just, you don't know in these things. And if you go over deals that we've done over 100 years, and you know, the ones that worked were surprised, and the ones that didn't work were surprises in the reverse fashion.
So I have an interesting question also, because we're going to talk a lot later today about new trends in liquidity and clearing and venture exchanges. And you know, Richie, you were basically, you were the aftermarket. I mean, that's, you know, we were sitting, you were the crowd, you were the aftermarket. How do you think that now, because I think that's really the biggest problem. We see in the Jobs Act, you know, really, as I always say, it helps companies get public. Maybe it facilitates the way that they could get public, and it makes the on-ramp simpler. But at the same time, you know, what happens once they get there? There's, you know, the highway is really what's still broken, and it's the infrastructure that we really need to fix. So how do you see it now? I mean, you know, with an aftermarket developing in some of these really small securities.
Well, see, firstly, Dara, there's so many underwriters that have gone out of business, number one, which has been a problem for small things. I mean, if it's an Uber or something like that, you know, the big boys are in there, and there's plenty of money out there. So, you know, that's not a problem, really. I mean, you got a $40 billion valuation, and to start the ball now, does a fund buy in at 40 billion? Where's it going? Is it going to 80 billion? A fund's not going in to make 1 times as money, 2 times as money. So I guess they're looking for over $100 billion for a public offering or thereabouts. But I think there is a lot more money going on out there now. And it does help the smaller companies, but yet the aftermarket on some of them is just not there.
Yeah.
It's a placement. When you get a hot deal, you go around the street and this guy will say, well, we'll give you 50 shares, 100 shares, and I test the water, and many times there's nothing to be had. Where's it all going? Is it going into the hedge funds? Is it going into the big funds? It's going to come back to haunt the underwriter most of the time anyway. The problem's been, to get the smaller guys, the fast money guys, not that much stock. And it's working now as far as that goes. There's certain underwriters, they're an automatic. There are about 3 or 4 underwriters that are almost guaranteed to be a premium on their deal. I mean, they really take time, and it's a big effort for them. And they go out and they say, hey, we really want to make this thing work. I mean, years ago, it was a factory. You go through the Merrill Lynch factory or whomever, without naming too many names, but it just didn't work. Because they just didn't care. They just didn't get. It was just like a warehouse. In, out, gone, and that's it. But it was fun. But working with some underwriters, it was a challenge. Really, because the underwriter has something that's called a green shoe. Basically, if an underwriter is doing 1 million shares, green shoe is 15% over, which the underwriter could sell an extra 150,000 shares.
At the IPO price.
Exactly. And they have a call to the company stating if the stock goes up and gets away from them, they can go out and buy it at the underwriting price. Then if the stock turns out to be a lemon and it starts going down, the underwriter has the option to go out into the open market and buy it to stabilize the market. And then there was something that was very tricky. That was a great tool. And another great tool is, but it's very tricky, is a naked short. Underwriters could go, if I say, gosh, this stock is going to really dive, and I think you ought to go into the naked short. And I have to be so right, because if that stock takes off, the underwriter can lose all the money he's made on a deal plus. So, it's a little bit of a challenge, but a lot of fun.
So do you think that today's, the next generation of broker-dealers and even some of these new rising platforms, should they get engaged and be part of the aftermarket too? Because it seems like that's what made it really work throughout the decades. It was that the underwriter came in, they facilitated the actual offering, but then they really helped create the aftermarket. And I think they really have to take a role in doing that.
We have to bring back some more of the smaller firms. Look, they had a kind of crummy stating behind them, and it really should be that they should be allowed in, and maybe FINRA can let loose a little bit.
Yeah.
I mean, everybody's been complete.
With respect to suitability, again, this isn't a knock on large firms. I spent 22 years at Lehman Brothers. That was my second.
I have more than that.
Okay, you always won. You're taller too. Yeah, and older too. I should. Often, I actually chair my firm's commitment committee, and all the different disciplines are represented: sales trading, research, banking, of course, capital markets, and the loudest voice is research, because there's an old saying, you date the banker, but you marry the analyst. And the analyst is the individual who's going to cover the new company for a minimum of 3 years at Needham, and generally it's almost eternal, with us. But unless the analyst is really bullish and positive on the issue, we don't do the transaction, which would suggest that we're going to come out and sponsor it. I mean, unless the stock doubles or triples the first day, we don't have to have many of those. We see very often when we're co-managers in the large firms, 10 days or 15 days after the analyst from the lead bank comes out with a hold at, at the issue price, or sometimes even below the issue price, which is really amazing with respect to providing sponsorship in the aftermarket. We see it very frequently, actually, which really is astonishing to me, which suggests to me that the issuer didn't go to the right, the right investment bank. To your point, I mean, the whole idea of focus, it's a question of economics, and for us to sponsor a small transaction with a small float and small trading in the aftermarket is really a long-term proposition.
Right.
I mean, at 3.5 cents a share, whatever we make on average, for us to, provide that human capital for, do non-deal roadshows, invite them to our conferences, trade the stock, do M&A, and so on. I mean, we really need to do multiple capital market transactions because the net present value of one transaction simply doesn't cover it. With the large firms, they get the lion's share of the initial economics. For them, it doesn't matter. So for us, we really need to be a little more selective, if you will, because we're going to be with these companies a long time, if that makes sense.
Yeah, so we have time for about 1 or 2 questions, and then if there's more questions later, we could take that in the breakout room. Yep.
So, Mr. Malik, you said that your comment was the issuer selected the wrong investment banker. How the hell is an issuer going to know who the right investment banker is? How would you even begin from Des Moines, Iowa, to figure out who is the right firm? I mean, FINRA's killed.
Well, they used to be. There still is. These beauty contests, and we all go and pitch. I spend 15% of my time visiting VCs and young companies to try to put forth our message, if you will, and our differentiated message. I really speak not only for Needham, but a whole bunch of firms like Needham, whether it's Cowen or JMP or Oppenheimer, or, whatever, a whole ilk of firms. I'm going to beg the question and just go back a little bit. When Andy Blum was running this business, and these guys were running this business, an issuer generally went to one of the 4 horsemen or of that ilk because of exactly the reasons I said. They had the relationships with the institutions who were suitable to buy emerging growth companies. And they would generally do the first deal, perhaps the second deal, perhaps a convertible. Then as the companies got larger and grew and prospered.
They got smarter.
And got, also perhaps smarter, but needed more services that the special firms couldn't, whether it was debt, whether it was a global exposure, whether it was a balance sheet, which we didn't provide generally. Then they went to the larger firms. And the original issuers, the 4 horsemen, if you will, were relegated to the next bracket and the next bracket, and sometimes dropped off, if you will, off that. Today, the whole process is inverted. It's inverted and perverted. Emerging growth companies, because the VCs love brand names, the issuers love to say that Goldman Sachs brought them public, and they have an offering, whether it's successful or not. If these companies, the issuers, miss a quarter or 2, or have a management change and so on, or the banker leaves, they drop off the radar scale of the large firms. And of the 50 or 60 transactions we did since I'm at the firm, since capital markets are open, we're lead managed, we did 200 or 300. Lead managed, I would say 90% of them were issuers that were forgotten by the bulge bracket firms. So now we're back. It used to be the specialty firms did the IPOs, the larger firms did the secondaries, the larger secondaries. Now the larger firms do the IPOs and the specialty firms do the secondaries because they've been abandoned by the larger firms. It's a kind of a perverse process. How do you find out? Through the forums like these. I mean, we have to prove to you we can do it. And so it's a little bit like selling against IBM in the old days, the really old days. It was called the FUD factor, fear, uncertainty, and doubt. And no one gets fired for picking Goldman. Sorry. Does that?
Thank you very much.
It was truly an honor.